appraiser out there in a couple days, you're also going to have still an underwriter review that property. And because prices keep escalating, they may have more conditions. Like we've had an appraisal that the appraiser didn't reply back to conditions for 3 days, right? And now you're looking at a contingency release, and what do you do around that? So that I think is kind of the biggest challenge we're seeing. We all know inventory's tight. It's kind of a seller's market, and we've got to just pivot to be able to be as more flexible as possible.
Thank you, Austin. Laura.
Yeah. I think Matt hit it. It's being more competitive. My clients, I have get conditionally approved, subject to finding the property. That allows us to shorten the close of escrow from 30 to 21 days or shorter, and makes us more competitive. So the analogy I use is this is like a beauty contest. And I don't know if my client's going to compete against 4 contestants or 14 contestants. So my job and the realtor's job is to make them be the most attractive offer out there. So again, that's getting them fully underwritten, conditionally approved, and shorten those contingencies. Now, Austin was correct on the appraisal. We've not really run into that. We're getting our appraisals back in time. The only time we're running into that is when we hit a holiday. So I noticed a slowdown 4th of July. I think appraisers finally were taking vacation. Same thing with the 3-day weekend. So I think the name of the game on that, though, is communication, communication, communication. If everybody knows, hey, it's due this date, we did get it back, we had to send it back for the appraiser to answer some questions. I think as long as both agents know we're all on the same page, we're okay.
Excellent, thank you. Ed?
All right, next question, question 3. I'm really interested to hear your thoughts on this question, panelists. So how can buyers compete in today's competitive market? What tools, what programs might you be able to offer that could give them that competitive edge?
Well, I think everybody here does have that TBD, that pre-underwritten pre-approval, right? Matt spoke to it, Laura spoke to it, we have it, we all have that tool in our inbox. But I think the best thing that we can do alongside with you is a partnership, is education on what are options if appraisal comes in low, or if they need to go higher with less down payment. I think that's a big strong point. And honestly, I think right now more than ever, we are part therapists and cheerleaders to keep people in the market because they are getting burnt out. That goes for you, that goes for us, right? Everybody is ready just to do more and help everybody else they can, but it does get hurt. Like when Laura said, or, you've got 8 people in the market, right? And Matt's like, I don't know which one to get it, but we all know everyone's writing on the same property, right? So I think for us, it's a lot of education along as what is it going to look like on a quick escrow? What does it mean to get fully underwritten? What can change? What can't change? What happens if things shift and you need to go higher? And just really communication and cheerleading on that side of it.
Great. Next, Laura, can you follow up with that on your thoughts?
Yeah, I think we kind of answered that in the prior question, and then Austin hit the same thing as, this conditional approval. A couple other things, talk to your lender about what programs are out there, because what we're seeing is buyers thinking, oh, I'm gonna buy $1 million home, and then they look at these homes, and $1 million really isn't that nice home you're wanting, and then they get their eye on that $1.5 million home. So there's some great programs out there with 10% down, 10% down, lender paid PMI. I think those are where you can get your buyer to be able to afford more. Also, talk to them. There's times that parents will give gifted funds for down payment, and allows them to buy more of a house as well.
I'm going to jump in, Ed.
Yes, well, I struggle for my unmute button. Yes, go ahead, Matt.
No worries. Yeah, I think the only thing I can add is educating and managing expectations for everyone involved, to educate the buyers, to make sure that their documentation is in and it's complete, and And then to manage the expectation side, both them and the agents involved. I mean, I think the only other thing I can think of that Austin or Laura haven't touched on is that calling the listing agent and making sure that the selling agent has a lot of confidence in the buyer that we've presented in the pre-approval letter that we've presented. Being a small town that, you know, you get a pre-approval letter that's a local lender, it usually that helps, but I think the telephone call to explain to them, we've got a full file, assets have all been fully verified, income's already done, files already essentially TBD underwritten, we've got a full underwrite. Things of that sort, I think are I mean, at the end of the day, that's all you can do as a lender, is to continue to support both sides of the transaction.
Very good. Very good. Thank you all. And I will pass it back to Liz. And before we get to question number 4, I just wanted to mention after question number 4, we're going to be opening up to questions from the audience. So if you want to enter in any questions in the chat box, please start doing so now.
Great, thank you, Ed. Our last question, we're going to give you a little bit more time. We've been moving quickly through the first 3 questions. So each of you can take, you know, I'd say at least 3 to 5 minutes. Ed, does that sound right? Yeah, that sounds about right. Okay, so our last question is, as a lender, what is your opinion on where the market is going? What's going to take place in the next 6 months to 1 year to 3 years out? We'll go first to Laura again.
Okay, so a couple of things that I think we're seeing now. There's actually 2 things I want to hit on. One is the new look of the first-time home buyer. So I've closed several loans recently where first-time home buyer is buying $2 million home. So think about that. I know we have some older people here. Could you imagine that your first home was $2 million? So how are they doing that? So they're getting gifted funds from bank of mom and dad, from parents or from relatives. And there's also the 10% down program, which allows them to get into the home that they want. They typically have the income. If they don't have the income, the other trend that we're seeing is parents being a non-occupant co-borrower. So they're actually on the application because people in this community want to keep their kids in this community, and how else are they able to afford a home unless they have the help from family members or a lower down payment. So that's the trend we're seeing, is that first-time home buyer that is not hesitating at a $2 million purchase price. So the second thing is, I saw this article from CNBC, and it said that the United States is short 5 million homes. Yowza. We know there's a big shortage here in Santa Barbara. So one of the things, another trend that we're seeing is people look for homes, aren't finding homes, and they are purchasing lot and looking to do construction lending. So seeing a big trend in that. I think they've closed about 13 lot loans this year. And again, a first-time home buyer, and they're looking to do construction. So I think you're going to see more of a trend on that. The good news is in Santa Barbara County, we do have quite a few lots out there and available. So that's my take, the trends.
Matt.
Great, Matt. Sorry, Matt next.
Yeah, so pretty broad scope. I guess I'm going to go more towards just kind of the trend of the market and where I see rates going in the 6th year and 3-year mark. I think with cost of building up, I think with debt, with the new government in place, and debt and all the COVID relief and all the things that we're trying to do to help those around us, I don't see rates going up in the next 6 months. I see them pretty kind of flat line. We may have a tick up in the next year, and in the next 3 years, I anticipate rates to go back down once we kind of have this settling and people settle back into the new world of living with another coronavirus as a daily or an annual thing that we need to watch out for. I think overall, the cost of building going up and a lot of inventory here locally, we're going to see I think the market's going to be very, very strong. And I think anybody that's well qualified will buy, and those rates will fluctuate 0.5%, maybe 0.75 of a point, and will open up further opportunity at the 3-year mark for a refinance opportunity to help save some money.
Thank you, Matt. Austin, your thoughts?
All right, I think definitely, I don't think rates are necessarily going to go. They don't really have a lot of room to go right now. My bigger concern is inflation. Inflation, just on an economic perspective, I think that's what's going to hurt people's buying power. Because as Laura mentioned, that's a $2 million first-time home buyer, right? And I don't think that the demand isn't going to decrease. I think it's just going to topple a little bit, that we will see a little bit less demand in the market. But overall, it's going to remain really, really strong in our world here. I think we are going to see expansion of the non-QM loans from the policy standpoint, where we think Fannie and Freddie are really going to start to be privatized. You know, it's not going to be like Wolf of Wall Street, the Big Short world, where they're just selling crap on the secondary market. Hopefully I can say that word, stuff on the secondary market. But I think you're going to see a bigger demand because, y'all, what we put everybody through the ringer, right? I mean, you can get 3% on a 3-year fixed rate and get that and reinvest it back in the market versus a savings bond, which is 0.1. So on that secondary market, it's a safer product. And I think you're going to see the more non-QM world. I also think that you're going to see more, to Laura's point, of construction loans come into play and rehab loans come into play. There is jumbo rehab products that are coming out. And I think that's going to be a lot more aggressive, especially for these first-time homebuyer buyers. I don't know if you guys, there's one, is it Del Carlo? That's not the right address, but there's one where like the roof is falling in and there's termite, and I know every single lender on this call like, oh my God, it's a under 900. How do we make it work? And you're like, you can't live there and you have no but, you know, right? So I think these products are going to start filling in that gap in the marketplace, because the people that are selling houses are dead, right? Divorcing or relocating, right? So these are houses that not necessarily have a lot of love. Like the money's not quite there for the flips anymore. So we're going to build it in internally. And last but not least, for Todd's question on the side in the chat of how do you bring your out-of-town people into a local lender, which we all know is better. They're not going to realize until they get burnt, right? And that's always a really hard conversation, because you can say, you can build your own panel of clients, right? Your own clients that you pool and survey and say, hey, I went with an online lender, I should have used local. So I would tell you to do that, start getting those type of survey, type of feedback, you know, something that you can report back to on that side of it. And I think the online lenders, you know, with margin compression happening, which in English means rates are, you know, there's less money to be made in the market, right? Because there was just such a free-for-all last year. With margin compression happening, the online lenders are going to look sexier to people, and we need to educate them that cost. I educated the clients, so if they close a week late and they charge you an extension fee, that would be the same, you know, 1/8 or 1/4 of a point that we would charge you day one, and we close in 21 days where they're going to close in 45. And so just educating people on the math and the pain around it, although I don't think we're ever really going to get away from it, because people these days like to swipe right and think that they're a loan officer. True story.
Great, thank you, Austin. We will be putting the questions in the chat out to everyone after we wrap up this phase of it, which we'll do almost now. But I have one question I wanted to follow up with that maybe Laura can add some color around. What are you seeing with respect to construction and modular homes? I'm seeing that as a trend that people are looking towards for more affordable building, and wondered if you are able to finance those and what you're seeing with that.
So we definitely can do the land or the loan, and it's that client purchase the land, then they go and they do their homework. Do they want to do modular? Do they want to do construction? So it I can't give you a straight answer. It depends on the modular home. If it's in USDA territory, we can. If it's here in Montecito, not seeing a modular home go there. But also I've seen a lot of clients looking at modular home, and when they look at the cost, it really doesn't make much sense because it's so expensive to get it here. So often when they look at the pricing, they decide to go with construction instead of modular.
Great, thank you.
Mm-hmm.
Let's see, what else do we have? Gene Cedar is asking, how can buyers needing a loan respond to sellers' counter saying no appraisal contingency? Panelists, jump in, feel free.
Go ahead, Matt.
No appraisal contingency. Keep your loan contingency in place. I think we're very fortunate. Actually, Santa Barbara. I haven't knock on wood. I don't even know if this desk is real wood, but let's assume it is. It's definitely we have yet to see an appraisal come through where value isn't justified. This market is very unique in that it has microclimates and weather. It also has microclimate real estate where every little pod and when you get good local appraisers that are part of an appraisal panel, they all kind of know this area. They can walk into the west side and justify a house on the west side versus one on the mesa. And so I think that fighting that back is just doing your due diligence on the front end and having all your ducks in a row and knowing that your loan is strong, and that and having a backup plan. I mean, if we do have a problem where appraisals come in short, then we know we have the assets to bridge the gap, or we have a plan B, because that's a tough one, and and we see a lot of it, especially in this competitive of a market.
Yeah.
Great.
I was going
Anybody
to
else?
chime in on that in the sense that we'll write it that it's not subject to an appraisal contingency for value, still for health and safety. Because you guys remember that's really our only inspection of the property. And whereas they may have more resources, you can flip a loan product like Matt and Laura have spoken to. If you do have big property issues, then it is still going to be an issue in underwriting. Because correct me if I'm wrong, guys, but the whole, oh, you just don't need a drive-by, you don't need an appraisal, it's COVID, like, doesn't really exist anymore.
No, health and safety trumps all, quite
Yeah.
frankly. Okay, thank you, panelists. We have a question from Marcella Simmons. Are funds from HELOCs to be designated for adding to the home's value? Let's see, I'm trying to understand that question. Are funds from HELOCs to be designated for adding? I'm quite sure. Marcel, feel free to type in any
That looks like Laura.
Well, I can see Marcella, and I was going to share you saying, can HELOC funds be used to like do a rehab or an ADU to enhance the value of the home? Is that Marcella?
Well, I was curious whether they were only to be used for the home's improvement. Some time ago, I heard that, that was the case. You could only put that money back into the house. And I just wonder if that's still the case or if it is.
That is not the case. So once you close on the home equity line of credit, it's a line of credit. It's yours to use how you wish. If you applied for a home equity line of credit and said, I'm going to buy stocks in the stock market, that's when the bank's like, yeah, we probably don't want you doing that. If you apply for a home equity line and you say, I am doing construction, the bank's going to go, wait a minute, we want to know exactly what you're doing. So basically you apply for that home equity line of credit, just say it's for future use, and then you can use it as you wish in the future.
Okay, let's see. Did we get everything on the chat? Are there any other questions? Yes. You've got 3 experts at your command. Let me take one step back for the group here. Austin, earlier we were talking about QM, non-QM. If you're a lender, we all know certainly what the heck that is, but maybe you can elaborate a little bit to everybody in this room what that's all about.
Thank you. I'd happy to. So QM is qualified mortgage. So if you remember back in the day, Dodd-Frank in 2009, I think is when that came out. Could be a little bit all blurs after 2007. And the banks are like, oh my God, help us. We have these loans, they went default, it's not our fault, right? And so the federal government's like, it's totally your fault. You guys did bad loans. So they said, look, we'll give you safe harbor if it is considered a qualified mortgage. So those are loan terms, 30 years or less, no interest only, no negative amortization, no balloon payments, and no prepayment penalty. And you have to do what's called ability to repay, ATR. So if you guys have ever heard, like, the underwriter has one question, it's ability to repay. Ugh, we're just going to pay our bills. The concept behind that is, from a lender standpoint, it's almost guilty until proven innocent. They have to show that for all intents and purposes, you can pay your bills. That it's not like you had a pulse and maybe a valid social, here's $1 million. So the non-QM products are those that are technically interest only, longer terms. I don't think we're going to see negative amortization outside of reverse mortgage. I don't think we're going to see balloon payments. I don't think we're going to see prepayment penalties, at least on owner-occupied loans. But I think we're going to see more alternative forms of qualification versus the 2 years tax returns, 2 months bank statements, kind of what Matt spoke to with the asset depletion programs or bank statement programs if you're self-employed. I saw a 1 month bank statement loan program out there. I did honestly throw up a little bit and said, oh my gosh, please no. But we are seeing more things come out in the market, and there's a big push, especially from Angel Oak and other investors, to go there.
And Austin or other panelists, what kind of trade-off is there when you're going non-QM versus QM as it relates to interest rate and points that the buyers will need to pay?
You want to take that one?
Sure. Yeah. So on your non-QM side, you're gonna see rates that are much higher. The loan at the end of the day, I mean, rates follow risk, so you're gonna see that those rates are gonna be higher than your prototypical jumbo even or conforming high ones. And all the in parentheses, the good ones, the ones where we're doing bank statement loans, the ones where we're doing investment properties for themselves, so they're actually not underwriting the individual as much as they're underwriting the property, showing that the property cash flows itself and lending on that single unit as an investment property solely. I see a lot of those come across with a point. Sometimes, depending upon credit and other qualifications, you can see that those investors want 1.5 to 2 points even, and that's part of compensation even to LOs like myself or mortgage advisors like myself or the others on the panel, where we're reaching out to broker a deal or find a solution for your client. We're trying to find the best solution for a client. We fall into a bank statement loan as the only qualification that works, and so there's always going to be points involved at some way, shape, and form, whether it's lender paid. So keep in mind that lenders will pay that point for you on your behalf by just making the rate higher. There's borrower paid, where they're going to pay up front their own point, and that rate will be extended generally a quarter, maybe a half a point less. I've seen it go a lot more than that. So it's I always joke, non-QM is just a lot more creative, and with creativity comes higher rate.
Thank you, Matt. Panelists, we have a question from Jean Cedar. Jean is asking, can you address buyer options who want to make a cash offer to be stronger, but would prefer to end up with a loan?
I'm happy to take that one on. I have one of those happening right now, and buyer shows proof that they can pay cash. He actually negotiated a longer escrow, and seller is aware we're doing the loan, but at the end of the day, if for some reason, we will get the loan done, but they're giving proof that they can actually pay cash. And that is where and I had a phone call this morning with somebody else looking to make an offer. Your buyer needs to be able to sleep at night. So if they're okay just having your inspection contingency period, and they feel confident that they have enough that they can move forward, if it doesn't appraise, which I've not seen. Everything's been appraising. I think I've had one in 18 months that didn't meet the appraisal, the purchase price. So as long as they can sleep at night, and this is a more savvy borrower, both of these, they purchased, sold and purchased. I wouldn't really necessarily do that with a first time home. I think that's too much. So I think it depends on your buyer and if they have a comfort level with that.
Thank you, Laura. Matt, Austin, anything else to add?
Austin?
Yeah, I mean, there's delayed financing options, but one thing I think House Lions don't necessarily put forth is a lot of clients that do have cash can do a margin loan. Every financial management house calls them different, pledged asset loans, right? Think of it as a 401k loan against your money market account, right? So to Laura's point, they always have to be comfortable, but maybe instead of having a huge tax event from a capital gains perspective, they're going against that line of credit to make up the difference. Or we're looking at doing delayed financing if they can pay cash, and we can come right back in there too.
And can you, Matt, can you elaborate on what delayed financing is to the group?
Yeah, absolutely. So delayed financing, have a client right now, same situation, can easily pay $1.3 million. They're going to go in all cash. They're going to close the transaction very quickly. Their appraisal this time around, hopefully they win the deal. Within 90 days, they can come back. In some programs, you have 6 months, depending upon if it's a QM non-product. But generally within 90 days, you come back and you can take a loan out on that property, back up to the original loan to value, up to 80% on some products. Some like it closer to 75, and there's always rates that follow with those loan to values. More favorable the loan to value, the lower the rate is. But to elaborate a little on the PLA, that pledged asset account's wonderful. Usually only a 3 to 3 year max. Sometimes it's a 1 year. So a lot of times we will work with the financial advisor to kind of make the transaction quicker on the buy side for both the agent and the individual or the client, but then together a longer term plan to put it into a 30-year fix to release those pledge assets back into their investment funds.
Great, thank you. Anybody else have any question for our panelists? Okay, I don't see anything else. Guys, I think Liz, we are ready to move on to our fun portion of this event here, featuring Sarah Sinclair and the famous raffle wheel.
Yes,
So,
Ani will be spinning the wheel now, and Sarah will be giving away her raffle prizes.
And while it's spinning, let me tell you, the first winner, the name that gets chosen right now, is going to win a gift card to Los Arroyos. And that was Rick Wilson.
Nice.
hey, Rick.
Congratulations, Rick. And then if we can move the wheel off the screen, I'll show you guys if you can see. My very scientific method of putting everyone's name on here that had their camera on for at least part of the show today, except for Liz and Ed and Matt and Laura and Austin. Although they all worked harder, their names probably should be on here. And I did not put myself on either. But closing my eyes, as you can see, the winner of a $25 gift card to the Little Kitchen, which is an exciting burrito. Not that you have to use it for burritos. The winner is, oh my gosh, it's Susan Bonanno. It's
Hey, Susan.
It was almost Eugene, but it's Susan Bonanno wins $25 to Little Kitchen. I have both those gift cards. I will put them in, well, I'll contact you both and we will figure out a delivery method. But everyone should eat burritos all week, $7, 16 restaurants. Thank you so much, Matt and Laura and Austin, for such a great presentation. I'll let you wrap it up, Liz and Ed.
Thank you,
Liz,
Sarah, so much.
away.
Thank you for your sponsorship and the great raffle prizes, and congrats to our winners. And thank you, panelists, for your time and expertise today. And I hope this was very informative for everyone who attended. Thank you again, and have a great afternoon.
Thanks. Bye.
See you at Los Arroyos.
Bye.
Bye, everybody.
Thanks, everybody.
Bye. Thank you.